Hello everyone and welcome back to FX Limit, your go-to channel for insightful Forex trading strategies and analysis. In today's video, we're diving into an exciting topic: how to use Bollinger Bands to identify potential breakouts or periods of low volatility in technical analysis for Forex trading. First off, let's understand what Bollinger Bands are. Created by John Bollinger in the 1980s, Bollinger Bands are a type of statistical chart characterizing the prices and volatility of a financial instrument or commodity over time. These bands consist of a middle band, which is a simple moving average, flanked by an upper and lower band. These outer bands are typically 2 standard deviations away from the middle band. But why are Bollinger Bands so crucial for Forex traders? Well, they are excellent tools for measuring volatility. When the bands contract, it indicates low volatility, and conversely, when they expand, it signals higher volatility. This is pivotal in Forex trading, as volatility can lead to potential trading opportunities. Now, let's talk about identifying potential breakouts using Bollinger Bands. A breakout occurs when the price moves outside the bands. As traders, we are particularly interested in strong breakouts, which often follow periods of low volatility when the bands are narrow. When the price suddenly breaks through the upper band, it could be a signal to go long, and conversely, a break below the lower band might be a cue to go short. But here's a pro tip: always look for confirmation. A single breakout isn't always reliable. It's crucial to use additional indicators or chart patterns to confirm the breakout. For instance, if you see a breakout accompanied by high trading volume, it adds credibility to the breakout signal. Let's also discuss how Bollinger Bands can help us identify periods of low volatility. Remember, in the world of Forex trading, periods of low volatility often precede periods of high volatility. Hence, spotting these quiet times can set you up for big moves. When the bands tighten and come closer together, it's known as the Bollinger Band squeeze. This squeeze is a telltale sign of low volatility and can often lead to significant price movements. But again, a word of caution: the Bollinger Band squeeze doesn't tell us the direction of the breakout. To gauge the potential direction, we need to analyze other market indicators and the overall trend. Is the market trending upwards or downwards? Are there any other indicators signaling a potential move? Incorporating Bollinger Bands into your trading strategy can significantly enhance your analysis. They provide a dynamic perspective on price movements and volatility. However, as with all trading tools, they are most effective when used in conjunction with other indicators and methods. Combining Bollinger Bands with trend analysis, momentum indicators, and perhaps even fundamental analysis can give you a holistic view of the market. Finally, practice makes perfect. Use a demo account to try out strategies involving Bollinger Bands. Observe how the bands react to different market conditions and practice identifying breakouts and squeezes. In conclusion, Bollinger Bands are a versatile tool in your trading arsenal. They can help you gauge market volatility, identify potential breakouts, and spot periods of consolidation. Remember, successful trading is about analyzing various indicators to make well-informed decisions. Bollinger Bands are a step in that direction. That's all for today's video on FX Limit. I hope you found this deep dive into Bollinger Bands helpful. If you did, make sure to like, share, and subscribe for more insightful Forex trading strategies. And as always, trade smart and trade safe. Until next time.